What's up, guys? I was talking to another person who was interested in investing in our fund, and I was telling them there's a few things that I like to talk to people about before they invest, right? And yeah, it would seem to not matter, but it matters to us as we talk about investing because you're going to be our partners. You're a limited partner with a general partner in the fund, but that matters because we're going to be married for like 7, 10 years in these deals until we cash out or until we continue to invest with each other, which is always my intention, is to have my investors be with us forever, right? We want to be a resource for real estate investments for you. So what I try to explain to them is number one thing you need to really figure out for yourself is what are your financial targets? And that's important because if you, let's say you have your own business, you have revenue, cash flow is not a problem for you. You're looking for your financial targets for you and your family in the future. Your investment should cover that. That means your decision should be, you should be thinking about that. What do you need now? And let's say you're 40 years old. 50 years old, whatever, 40, let's go with 40. 20 years from now or 10 years from now, your kids are going to graduate high school. Now you're looking at college. Are your investments going to be good for them? Do these investments actually help you hit that target? Will this pay for college for your kids? And should you start doing that stuff today? So you have your right now covered, right, with your business and your revenues and whatever. Now you're okay, 5 years from now, my kids are going to graduate. Where does that put us? Or 5 years from now, we're going to be looking to be at retirement age, even though we may not exit our business, or maybe you are going to exit your business. Will your investments still be the thing that you are looking forward to? Will you have enough equity built up? Will your investments have doubled during that time? That's important to know. And then later, for your older years, like what are your financial targets then? You don't want to be 80 or 70 or anything like that and have your spouse or people that you care about or even your kids and have to take care of your children or your business have a disruption and you need to put into that. It's okay for it to come through your investments. That's not what you want, but you need to have it and you need to know that. So you need to plan for short term and long term futures if you're going to set a financial target. And I'll be honest with you, they need to be pretty big. Um, just in general, I tell everybody you need to get yourself in a position where you're investing at least 1 million, 2 million, $5 million, and then having the cash flow from that $5 million at let's just say 5%. We'll just use 5%, paying you, 25,000 a month. Like that makes more sense to go through and think through because now at least you have a target. If you don't have 1 million to invest, let's say you're going to start small, say you're going to start with the minimum of 200,000, or let's just say 500. If you're going to do 500,000, then you know to get to 2 million, you're going to invest at least 4 times with us. So you need to be like, hey, revenue targets that we need to generate on our company after we pay expenses and taxes and pay our employees and look at through expanding the company, are we going to make sure that we have every year $500,000 to go into some investment opportunity with Bell Capital? That should be a target for you, right? That's a financial target. Next, is it the right vehicle? Now, let's just say you're not going to go with us. You need to still have a best vehicle. A lot of people think that their business is going to be their retirement vehicle, but be honest with you, that's not always the case. You have a lot of people who run a dental practice, you have a lot of people who have chiropractic offices, or you're an engineer, or you're a tech person, and you're working at a firm or you're building your firm. And at some point, you want to be able to exit, but that may not be the right vehicle for your investments in the future. It may fund your investments, but it may not be the investment vehicle that you want to keep your capital in, right? Because let's face it, what was the numbers? Um, I think it was like, the generic number was 1 out of 9 businesses fail. But if you're already past the part of failure, you're already like, hey, we're making 2 million, 5 million, $10 million in revenue. That's gross. But here's where we are. But this is what I've set off to the side. Then you need to take a look at that from that perspective. Not all businesses are going to continue on into the future. Like right now, look, AI is killing a lot of different businesses. Can your business withstand the AI bubble? Which means what? You need to plan for the future to say, is this the right vehicle for us long term? Will it last 70, to you're 70 years old if you're 40 or whatever, right? Next, the right tax strategy. So, real estate to me is the best tax strategized investment or an alternative asset anywhere on the planet. If you're going to do it yourself, you can do 1031s. You got you got the bonus depreciation, you got cost segregation, you have regular depreciation if you're not going to accelerate it. You have all these different benefits if you're going to be investing as a limited partner in Bell Capital because you're going to be a partner in the deal. You get your limited partner. Now, if you're going to invest in a REIT, you don't get those same investments. If you're just going to say, hey, we got this money, we're going to listen to our RIA, we're going to put into a REIT, we're going to have some real estate, but that's not really real estate, right? You're buying shares of a company that owns real estate, but you don't own any real estate. So your tax strategies have to come into play. If you make a lot of money and you're looking for write-offs, that's a challenge. Or if you're looking to make an investment that gives you a distribution like we do, then you want to have an investment that actually gives you the tax benefits so you keep more of what you make. So, for example, and again, can't guarantee this, but this is what we targets are. Let's say we're targeting a 5% return on your money, and same $500,000 that you would invest, right? We'll use 500,000. You're going to be getting roughly, let's just say $2,500 a month. Now, if I give you the tax benefits and the write-offs of that, and you're getting to keep the full 5% of your cash flow that you got, let's just say that that happened. That 5%, because you're keeping the 2,500 a month, whatever that works out to be for you as an annual thing, is the equivalent of, like I tell people, let's say you're in a high yield savings account and you're getting 4% on your money or whatever, right? If you are taxed, that's earned income on that earned income that you receive on the return, on the yield, and you get taxed at 40% of that. That is like getting only, instead of getting four, now you're only getting like what, two, two and a half, somewhere in there. But if you're getting five and I'm giving you the tax benefits and you're not getting taxed the other 40% on the 5%, that's like me giving you 6 or 7% return on your money because you didn't have to spend it. Right. The goal here is to keep more of it you make. So you can't do that if you aren't focused on what your tax strategy is going to be. Now, some of that stuff can offset some of the other business revenues and incomes. You need to consult your attorneys about that. We have some strategies for that. But I wanted to share that with you that that should be a part, not only setting your financial targets and targeting the right vehicle that's going to help you, that vehicle should also spill into your tax strategy. You don't want to be in a situation where you're getting hammered with taxes like the rest of the people on the planet. Like that's why you invest in the right vehicle. Next, you want to have actually a long-term plan, which goes right back to your financial targets, the right long-term plan. So if there's an investment that you can invest in long-term, you shouldn't be in it because anything short of, to me, 3 years, that's gambling. Like, especially if you're in a real estate deal. Like if you're in a big commercial grade apartment complex or multifamily real estate where like the stuff we look at, I don't want to look at the debt for 3 years, maybe 5 years. If I have an exit strategy of saying, hey, look, in 5 years, we're going to trade out of this by refinancing and bring in more capital, give my investors their capital back, de-risk my investors, and then we're going to put on new debt. That may be 3 years or 5 years because we know we're going to exit the asset during that time. Don't know. But I'm explaining that to you to say, when we think long term for our investors, and you should too. So, one, you need your financial targets. Two, you need tax strategies that benefit you and your financial targets, and being in the right vehicle does that because you buy stocks, there's no tax benefits to that. You buy gold, there's no tax benefits to that. You get into Bitcoin, there's no tax benefits to that. You leave your money in a in a retirement account, you may you're going to get hit with a tax bill at some point. It's going to come out to you. You're going to take it in. It's going to be earned income. It's going to raise your the tax bracket you're in typically, right? And you're going to pay taxes on that because how many believe taxes is going to be higher than it is today in the future? 1000%, period. And then next, and really the main thing is you need to be thinking long term. The investment you need to be in should be able to withstand the test of time as long as you can keep it. And income producing, institutional quality real estate, like the type of stuff we look at Bell Capital, truly does that for you. So if you're thinking about investing with us or with anybody, you should always be thinking like, and this should be an estate plan for you and your family. It should be a wealth plan for you and your family, and it should be an exit plan for you and your future, the current business that you have. If you exited your business and you had a great exit, your investments should keep on pumping, and you should just be able to double down on what you got from your exit into your current investments because they're winning for you. Put your money to work as hard as you did to earn it. That's the game. So I wanted to share that with you because I was sharing that with this gentleman, and we were talking about that. He has a practice, and he was like, "Hey Vic, what should I be looking at if I'm thinking about investing?" He has stocks. He's in a lot of the traditional investments. He was like, should I buy a home? I'm like, dude, look, this is something that you should look at. What are your financial targets? Where do you want your family's money? And is it going to continue to pay for you and your family now, medium, and long term into the future and take care of you guys long after you've made a decision to be like, hey, I don't want to do anything anymore. My investments have doubled, quadrupled, and continue to pay me long after my business has moved on. All right. So I hope that helps. I wanted to make this short video for you in the studio, and I'm going to jump out. But if you guys need anything, go to bell-capital.com. You can do two things there. Schedule a call, have a conversation with somebody on my team. We have an open fund right now. If you have at least 200,000 or more to invest, we would love to have a conversation with you, answer any questions that you have.